Hi, Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Betul Adawiyah binti Shahizan, and I will start off with the introduction of capital structure. So basically, what is the meaning behind or the definition behind capital structure? Okay, let me explain. Capital structure is to refer to combination of many funding sources which consist of shareholders' equity, external debt, and companies' retained earning. Did you know that capital is one of the most important elements for a company to operate their business? It is because how the business is going to run well without sufficient amount of capital, right? Okay, let me explain. Well, technically, capital structure can come in two forms, which is called equity and debt. Equity capital is a funds paid into a business by investors in exchange for common stock, while loans and bonds are considered as debt. Even though those two components hold two different meanings, but investors still expect a return or dividend from it. Those two items bring a huge effect on companies' profitability, and it is the responsibility of financial management to determine which component can reduce the cost of capital and increase companies' market value. During this rapid growth of economy, we can see that it's a huge expansion of investment opportunities. The widening of financing options and dependence on capital market has also increased. So basically, equity is a part of capital structure that consists of two components, which is common shares and preferred stock. One kind of equity investment that offers a fixed rate of return and possible additional benefits is called as preferred stock. So basically, preferred stock often pays a regular dividend on a monthly, quarterly, or annual basis, which produces investment income. A preferred stock's dividend payment is comparable to a bond's coupon payment. In terms of yields, investors in preferred stock generally know in advance on how much they will earn or they will receive because the dividend is paid at a fixed rate. Meanwhile, common shares have no yield guarantees because the dividends received by shareholders from companies are based on the company's performance, not at fixed rate as preferred stock. But the advantage of common shares is that common shares are more volatile than preferred stock because it has high potential to increase in price and it benefits shareholders from a growth in the company's worth. Well, next is retained earnings. Let me go further into retained earnings as well. So basically, retained earnings means the remaining income left after the issuance of dividends to shareholders and investors. A business that prioritizes growth will ensure that the remaining income, which is retained earnings, will be reinvested back into the company as part of the expansion to the business. For instance, these funds can be fully utilized on working capital and purchasing of fixed asset, which is part of capital expenditure, and or the company allocating some of the income for funds to pay off debt obligations. Next, other purposes of retained earnings that company can invest is that company can invest on research and development, buying new equipment or other activities that could possibly help the company to generate growth for the company and achieve more earnings in the future. Last but not least, the second component of capital structure is debt, which is bond. So basically, what is bond? Okay, the definition of bond is debt investment where a company or a government issues a bond to the public or selected people as one of their ways to obtain funds for the operation of a development project and so on. So technically, bonds issued by borrowers involve projects that require large funds, and bonds are also fixed income instruments because, in short, the borrowers such as companies give investors a fixed coupon rate and fixed interest rate. That's the end for the introduction of capital structure. Next, I will explain about optimal capital structure. Optimal capital structure can be defined as the best combination of debt and equity financing that maximizes company's market value and minimizes the weighted average cost of capital, which is WACC. So, why do we want to get optimal capital structure? It is because a company has to ensure that a company has a greater present value of cash flow and the lower in cost of capital, which will indirectly maximizes shareholders' wealth. Did you actually know that what is the benefits behind the optimal capital structure? The answer is, it can aid in mitigating risk if the company lacks ability to tolerate a larger debt to equity ratio. So, how do we obtain optimal capital structure? Okay, we can obtain optimal capital structure by calculating WACC, weighted average cost of capital. And in order to determine the best optimal capital structure is that the company have to make sure that they get the lowest possible of WACC. Doesn't matter how many comparisons they make, they have to make sure that they get the lowest one in order to get the optimal capital structure. Before we go further to WACC, let me define what is WACC. WACC means the combination of two components, which is equity and debt in the capital structure, which is it will cause a company to choose which components is cheaper and less expensive one, just in order to reduce the average of the two. So generally, in finance, debt is actually less expensive compared to equity when it comes to capital structuring. Why? Because it carries less risk, because the necessary return for the investor is lower than that of equity investors. Another reason for this is that dividend payments, which are optional, and they're actually paid after interest, which is often paid at a predetermined rate and with a mandatory status. Just like the previous one, I said that debt is less expensive compared to equity. But you know what? If a company keep issuing debt just to avoid the expensive equity, it will actually indirectly lead to the higher risk as well. Because issuing more debt means that more interest is paid out of profits before shareholders can get their dividends paid, and the company will more exposed to bankruptcy risk. Other than that, because the increased interest payments must still be made even in the event of a bad year for the company, which could have an impact on the company's capacity to pay dividends to the shareholders. So last but not least for this topic, I would like to explain that it is really difficult to get accurate optimal capital structure even the financial management of a company tries several attempts which they operate within a range of values. So the summary from my part is that issuing more debt to replace expensive equity could actually reduce the WACC. But the cons is that making more debt also increases WACC in terms of gearing and also exposure to financial risk. Lastly, a business with strong prospect will attempt to obtain funds by taking on debt rather than collecting equity or the money owned by the shareholders. And the goals of this action is that to keep the market from being misled and from being diluted.
Assalamualaikum warahmatullahi wabarakatuh. I would like to continue. There are numerous factors that could affect capital structure and their capital structure decision. It exists due to many factors, either internal or external. Hence, I will present 3 factors that affect capital structure and their decision. Economic cycle definitely could influence a company's capital structure. During expansion, companies tend to take on riskier projects with higher potential return. They may take more debt to finance growth and expansion plans. Hence, capital structure decision during expansion phase is companies are willing to lend external funds to access additional debt financing and invest in positive NPV project to make profits based on pecking order theory. However, during recession economic forecasting gloomy and companies tend to become more cautious. They will focus more on safer projects to maintain stability and prioritize paying down existing debt or avoid taking new debt. The economic cycle creates a dynamic environment where companies constantly evaluate their capital structure. The graph here shows a depiction of a business life cycle or stage of business growth, which is start from startup, growth, maturity, and decline. Scale of the company. Size of the company also affect capital structure and the decision. Huge companies are more likely have better opportunities compared to small companies. Large companies are well established due to having better track records and more assets, make them more creditworthy in the eyes of lender. As a result, large companies can secure debt financing with lower interest rates and longer repayment periods. Also, the interest payment on debt are tax deductible, which can significantly reduce a company's overall tax liability. While small companies may find it difficult and costly to get debt financing due to limited financing options. Due to less stable cash flow are often perceived as riskier by lenders, small companies need to rely on equity financing such as issuing stock to avoid debt obligation. And the last one, management team decision. Capital structure usually shaped by the decision board of director or management team based on their decision about the future prospect of the economy, growth, opportunities, financial performance, and maturity of the company. They aim to find optimal capital structure to maximize potential progress. So, during downbeat assessment, company made decision to reduce debt to avoid defaults due to potentially weaker cash flow. They become more conservative with investment and prioritize building cash reserves. While in economic boom tend to make companies make more debt to higher potential return and provide them with larger payout in the future. Next is financial distress. Financial distress is a situation where an individual or company is unable to earn enough money or income to pay back debt or meet their financial obligations. This is challenging for any organization as it indicates a significant contrast between the amount of debt it has outstanding and its ability to fulfill its responsibility. Financial distress may occur for several reasons. First is Poor management, lack of accounting and planning may affect organizations cannot see where their money goes and lead to overspending and difficulty to allocate resources effectively. Next is high fixed costs and excessive debt, play a role that lead to financial distress. This factor can be a burden especially during economic downturns. Also, high debt payments can significantly reduce a company's cash flow. Implementing a strategy to reduce fixed costs and debt without negatively impacting main operation is essential for business health. Lastly is inflation pressure. Inflation can decrease consumer demand and limit a company's ability to raise prices. So, implementing strategy price increases that maintain customer satisfaction is crucial by finding ways to reduce operational costs and help offset the impact of inflation. As part of corporate finance, the concept of cost of financial distress plays a significant role and affect the operation and financial stability of a company. It can be defined as the negative impact of financial difficulty and impending bankruptcy on a company's profitability and operations. There are a few potential solutions to mitigate the cost of financial distress like structuring finance, refinancing debt, or equity financing. This graph indicates how the company's debt influence its market value and show there is an optimal amount of debt. A company should have to maximize its market value. When a company's debt increases moving to the right, the value of the levered firm initially increases. The point at which the firm's leverage reaches its maximum is considered the optimal amount of debt. Beyond this level, the increased cost of financial distress exceeds the benefits of debt financing and the firm's market value begins to decline. Understanding this concept is crucial, especially for the firm because it can help companies finance their operation more competently.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Shahira binti Ibrahim. I will continue about the integration of the tax effect and the financial distress. Before I proceed, let's take a look for the definition of the tax effect. The tax effect will impact the company, the shape of company for the financial performance and decision. This will refer to the company accounting choices and financial transaction that will influence its taxable liability and the tax income. Next, I will give a simple and a short meaning for the financial distress. Financial distress refers to the financial challenge that the company face, like bankruptcy or the cash flow problem. Next, I will present about the integration of the tax effect and the financial distress cost for this graph. So, this graph is basically show the relationship between the debt and the value of the firm. Which is the x-axis refers to the debt and the y-axis for this graph is referred to the value of firm, which is V. Green line for this graph is referred to the VU, which is the value of firm with no debt. This value is assumed constant regardless how much debt the company has. The graph shows the present value of tax shield of the tax will increase and the debt also will be increased. This reflects the tax advantage of debt financing. The interest payments on the debt are tax deductible, reducing the firm's taxable income and consequently which is the tax liability. The greater the debt level, the larger the tax shield or the benefit to the firm's value. Besides, for financial distress graph, the graph shows the present value of the financial distress will be increased as that the debt level will be rises too. The curve represents the increasing risk of financial distress associated with the higher debt. So basically the graph is that refers to the debt that can have be both, which is a positive or negative effect on the firm value. So the tax shield of the tax benefit on the debt is a benefit because it reduces the firm's tax liability. Next, let's move on to the agency cost of equity. Agency cost of equity refers to the potential conflict of interest between the shareholder or the principals and a management, which is the agent. This conflict arises because of the shareholder want a manager to take the decision that will benefit them as a owner. But in other hand, a manager willing to take a decision that will benefit them or expand their business. The disagreement between them are called the agency cost. For example, the shareholder or the owner want a dividend RM1 ringgit, but the manager or the management not agree for the 1 ringgit dividend. They refuse to give only 20 cents for the dividend. So the disagreement and the conflict between them for the dividend is called the agency cost. There are several key components for the agency of the equity. The first one is managerial opportunities. This component occurs when the management acts in their own self-interest rather than in its best interest of the shareholder. For example, management may pursue projects that increase their own compensation or prestige but do not maximize the shareholder wealth. So this can lead to a decision that will benefit the management and the expenses of the shareholder. The second one is monitoring cost. Monitoring cost is the shareholder will incur the expenses to monitor the management action and ensure they are acting in the shareholder best interest. This can include the hiring of the external audits, conducting financial analysis, and attending the shareholder meeting. The last one is the suboptimal capital structure. This is the decision that management may choose a capital structure that does not maximize the shareholder value, but instead reflects their risk preference or desire to job security. This can result in a capital structure that is too conservative or too aggressive. This will leading to the higher cost of capital and will lower the shareholder returns.
Assalamualaikum, I'm Atika Basara binti Asman with matric card number 2023131419. We'll continue the presentation. Did you know that pecking order theory stands a fundamental concept that explains a firm's financing decisions? This theory offers valuable insight into how firms prioritize different sources of financing to meet their capital needs and offer a simple but powerful framework for understanding how firms make decisions to finance their operation and growth. This pecking order theory suggests that firms have a hierarchy of financing sources choice, with internal financing that retain earning being the most favored, followed by external financing that issue debt, and finally equity issuance. For retained earning is when a firm making money from its own operation and profits. Internal funds are attractive because they come with no string attached, such as no interest payment or vesting. Firms prefer to use internal funds first because they are easy, cheap, and do not send any negative signal to investors. But when internal funds are insufficient, firms may turn to borrowing money. Debt financing involves taking out loan or issuing bonds. Debt can be attractive because it allows companies to access large sums of money without giving up ownership or control. But too much debt can be risky, as the firm has to make regular interest payment and eventually repay the principal amount borrowed. If a firm still need more money and after exhausting internal fund and borrowing option, it may consider selling ownership share, known as equity issuance. This is like inviting other people to become part owner of the firm in exchange for their investment. Equity financing can provide a significant infusion of capital, but it comes more the disadvantage of diluting existing shareholder ownership and potentially relinquishing control to the new investor. For your information, the pecking order theory and trade-off theory offer different perspectives on how firms make financing decisions and manage their capital structure. This is because the pecking order theory does not have a target debt equity ratio and profitable firms use debt, while Pecking order theory emphasizes information asymmetry between managers and investors and a preference for internal financing. Trade-off theory considers a wider range of factors including tax shield, bankruptcy costs, and agency conflicts. This theory has several implications for corporate finance, which is suggests that firms should prioritize financing strategies that maximize internal financing, such as efficient capital allocation and profit retention. By doing so, firms can minimize the need for external financing and maintain financial flexibility. The pecking order theory implies that firms should be cautious when considering external financing options, especially equity issuance. Firms should be mindful of the signaling effect associated with different financing choices and strive to avoid actions that may send negative signal to investors. The pecking order theory highlights the importance of understanding the cost and benefit of different financing sources. In such case, firms must carefully evaluate the trade-off between debt and equity financing, taking into account factors such as tax implication, risk management, and the firm's growth prospects. Next part is about signaling hypothesis. Signaling refers to the act of using insider information to initiate trading positions, and it is another important concept in corporate finance that shed light on how firms use their financing decisions to convey information to investors and the market. In finance, the signaling hypothesis suggests that the firm use their financing choices to send signals to investors and their inherent value, future prospects, and their current funds. We have two signals which are positive and negative signals. Positive signals are when a firm issues new equity by selling the share or increasing its dividend payment. This can be seen as a positive signal to investors, indicating that the firm is financially strong and expect good performance ahead. Besides, the negative signal if when a firm decides to issue debt which takes on more loans or cut its dividend payments. It can be interpreted as a negative signal. It could imply that the firm is struggling financially and doesn't see promising opportunity for growth. Investors may view this as a sign of weakness and become cautious about investing in the company's stock. From signaling, firms can aim to optimize their capital structure by determining the ideal mix of debt and equity financing that maximizes shareholder value. This optimization occurs where the marginal subsidy to debt, such as a tax shield on debt, equals the marginal cost of debt. The marginal subsidy to debt represents the advantage gained from debt financing, while the marginal cost includes factors such as interest payment, risk of financing distress, and potential effect of creditworthiness. Next, by using signaling, the investor often interprets a firm's level of debt as a signal of its value and prospects. The higher level of debt may signal confidence in the firm's ability to generate sufficient cash flow to cover debt obligations, implying financial strength and growth potential. Firms anticipate profitability influence their capital structure decisions. Firms with low anticipated profits or uncertain cash flow projections may option for a conservative approach and maintain a lower level of debt to mitigate financial risk and ensure solvency. Conversely, firm with high anticipated profit and strong cash flow generation may feel more comfortable taking on higher level of debt to leverage their earning and finance growth initiative. Managers who prioritize short-term signaling over sustainable financial management may ultimately face higher borrowing costs, credit rating downgrades, loss of interest trust, and potential negative impact on shareholder value. In summary, the signaling hypothesis highlights the role of financing choice as a means of conveying information to investors. So that's all from us. We hope this explanation about capital structure is delivered clearly and easily understood. Thank you for listening and watching this presentation video. We really appreciate it.